isn't there also many trillions in U.S. Treasury debt that needs to be rolled over in the next 2 or 3 years? So it's the U.S. federal government can't pay. For listeners out there, the national debt is well over 30 trillion. We're never going to pay it back. It's going to keep growing. All the people in DC care about is servicing the debt, the interest payments on the debt, and the national debt keeps growing. But a lot of this debt has to be rolled over, which means that the debt has to be extended because we can't pay it back. So how much of this debt has to be rolled over then in the next 18 to 24 months?
Something like half of it. I don't have the numbers in front of me, but something like
Whoa.
half. Yeah, something like half of U.S. Treasury debt is short duration T-bills and short-term T-notes, maybe like a year or two, or 2 years. A lot of it actually is very, very short duration, and they've actually somewhat lowered their duration over the past couple of years. And so yeah, that basically represents a lot of money that has to keep rolling over and over again into treasuries. And so a lot of their debt is going to be adjusting upwards if rate hikes do materialize.
So if the Fed keeps hiking rates, then in the past, rate hikes would attract foreign investors to buy U.S. Treasuries, but that's not really happening to the extent that it did in the past. So if the Fed keeps hiking interest rates, that's actually going to hurt the ability for the U.S. Treasury to finance itself to pay the interest payments. And then wouldn't that mean that the Fed would have to restart QE or whatever they're going to call it this time, and then they would have to expand their balance sheet again and buy even more treasuries then to make sure the government gets funded?
Potentially, yeah. The problem, so they're like, let's say Japan, for example. Let's say you're a private Japanese investor, maybe not the sovereign, at the entity, but you're a pension fund there, and you want to buy treasuries. Generally, you want to hedge them back into the yen. Maybe not today because the yen's like going under this like abnormally rapid devaluation because of their yield curve control. But in a normal situation, they want to hedge their treasury exposure back into yen so that they don't, you don't want to take like 500 basis points of currency exposure risk for something yielding, 200 basis points a year, for example. And so they usually hedge that back into their own currency, or at least a big chunk of it. And raising short-term interest rates raises their hedging costs until you can have a situation where it's no longer profitable, despite the yield difference between U.S. Treasuries and Japanese debts, for them to keep buying U.S. Treasuries, because after the yield after hedging becomes equal or even lower than their Japanese government bonds, and so they're only willing to then buy the treasuries if they're willing to take on the full, currency risk of a movement where, say, the dollar goes down compared to the yen, which happens period to period. And so basically, when you hike the dollar, when we hike interest rates, it has a couple effects. One is it increases hedging costs, and then two, it strengthens the dollar. And so all these countries with a lot of dollar-denominated debts, they have trouble keeping buying treasuries, and if anything, they become sellers of treasuries in order to get dollars. And the Fed still, they have a couple options left in terms of things they could do that are less bad optically than turning back to QE during a time of inflation. One is that they could adjust the supplementary leverage ratio for U.S. commercial banks, so they can have U.S. commercial banks have easier capital requirements, basically not have to count their treasuries on their balance sheet really as against their capital ratios. And that would effectively, that's like jargony, but basically it would allow them to buy more treasuries than they are currently. And so you'd have that, you'd have a very similar effect overall, but it would basically be on commercial bank balance sheets rather than the Fed balance sheets. So it would increase M2, but it would not really increase the monetary base. So that's one option that they could turn to. And actually Powell's mentioned that. There's a number of officials that are looking at that. They did temporarily do that for a year during the 2020 crisis to add some liquidity to the market, but they could permanently adjust some of those ratios a little bit to basically, give banks more firepower to hold treasury. So that's number one. And number two is that they can do like, the U.S. actually holds almost no foreign exchange reserves. So we have our gold holdings, we have a little bit of SDRs, very tiny, trivial amounts of foreign exchange. Most emerging markets, for example, many of them have, 20% of their GDP in foreign exchange reserves, 30%, 40%, depends on the country. Developed countries often have 5, 10% of their GDP in reserves. The US is something like 1 or 2%, and it's all gold, pretty much. Because we're the axiom of the system, we do not have foreign exchange reserves. And so if there's some sort of like disorderly currency problem globally and the dollar's going up and no one's buying treasuries, one thing that the Treasury can do, and actually the Fed can't do it unilaterally, the Treasury has to initiate it really. The Fed would help, is that they can actually decide to increase their foreign exchange reserves, so they can actually go out and buy, European government bonds or Japanese government bonds, with kind of the caveat that those countries would then turn around and buy some more U.S. treasuries as well, and basically relieve them of some of their QE pressures, so that they can direct some of their effective QE to U.S. treasury markets, and they can market that as some sort of Plaza Accord 2.0, kind of a global exchange rate stability accord, whatever they want to call it. They can call it something other than QE, but it would effectively be QE, but it's just through different mechanisms. So there still are these roundabout things they can turn to if they start to see disorderly treasury markets again. And I think this is going to be the kind of decade where you see wonky things like that happen, just because of how much sovereign debt's in the system.
More rules changes from central banks. To explain that more simply, what Lyn is suggesting is that these central banks and governments might just change the rules, and then these governments will create their own currency out of thin air and then go and buy foreign government bonds of another government. So they're not doing QE, they're not monetizing debt of their own government debt, they'd be buying another government's debt. So if one government failed, the other one would fail like dominoes. This is absolutely ridiculous, but unfortunately, this is the type of bonkers new normal world we live in with stagflate tax lie.
Yeah, and it's something that we've seen, for example, Switzerland, because they always want to decrease their currency strength. So left to its own devices, the Swiss currency would be arguably the strongest currency because they run massive current account surpluses. They have low sovereign debt. They do have somewhat of a housing bubble, though, because their interest rates are so low. But basically what Switzerland does is that at all costs, they want to avoid their currency from appreciating too much. So one is that they were, until very recently, they were holding their interest rates at negative 0.75%, which is lower than Europe and the rest of the world. And so it kind of deters too much capital from going in. And two, they would just print Swiss francs out of thin air, and they'd buy like Apple stock.